You ever see that meme that goes, "Your savings account is a reverse ATM. It shrinks 4% while you stand there"? It's funny until it isn't, because inflation really is sandblasting every dollar that's waiting for the right time. Meanwhile, an estimated 1,700 new millionaires are made every single day in the U.S. alone, and they're not doing it by hoarding cash in a low-yield money market account. They're mixing boring index funds with assets most people still think are fringe, and they're doing it on autopilot. For more secrets of the wealthy, be sure to subscribe. Now, stick around, because in the next few minutes, this video delivers the exact recipe they use, the order they fund each bucket, and the rookie traps that keep 90% of people stuck at zero. The Millionaire Subway Map. Most people picture wealth like a straight highway: job arrow, save arrow, retire. Young millionaires treat it like a subway map. You transfer lines fast, you skip stations, and you definitely don't ride the same train forever. Their first transfer is always the same. Max out asymmetric risk, tiny amounts where the upside dwarfs the downside. For example, one barista poured tips into ETH in 2017, exited at 200 times, rolled profits into a duplex, and coasted to 7 figures before most people finish grad school. No lucky coin, just the map. Core engine, index funds on steroids. Step 1 is deceptively dull, low-cost index funds. 94% of young millionaires still own the S&P 500, but they juice it two ways. First, they dollar-cost average weekly, not monthly. The extra volatility smoothing can add upside, especially in volatile markets. Second, they overweight small-cap value ETFs for the first 15 years. Historically, that slice of the market has beaten the broad market over long periods, sometimes by 3% or more annually, though it can underperform for long stretches. Boring? Maybe. But $500 a week into that setup can clear $1.2 million in 21 years, assuming historic averages. That's millionaire status before the midlife crisis hits. Cash flow real estate, not HGTV real estate. Once the index engine is humming, they sprint to asset number 2, real estate that pays them to exist. Forget flipping. They buy a duplex or fourplex, live in one unit, and let tenants cover the mortgage. The average down payment with an FHA loan is 3.5%, and the average cash-on-cash return can be high if you buy right. Do it twice, and you've got 2 assets appreciating, 2 sets of renters mailing checks, and a tax code that can be very friendly to property owners. The secret sauce is the BRRRR method: buy, rehab, rent, refinance, repeat. This is how one junior developer managed to own 6 stores before 30 without ever earning 6 figures from code. Retirement accounts, the stealth Fort Knox. Plot twist, they still love 401ks and Roth IRAs. The difference is they max them out as early as possible. For 2025, that's $23,500 for a 401k and $7,000 for a Roth IRA. Since markets historically go up more often than they go down, studies have shown that lump sum investing tends to beat dollar cost averaging about 2/3 of the time. Inside the account, they often skip target date funds and build a barbell. 80% total market ETF, 20% long-term treasury calls. When equities tank, those calls can spike. They rebalance into cheaper stocks at the bottom. Over a career, that tweak could add significant value without extra saving. Crypto, the 5% lottery ticket that pays off. Next subway stop, crypto, but with guardrails. They cap exposure at 5% of net worth, split between BTC and ETH only, with keys on a hardware wallet. 5% is small enough that a total wipeout doesn't derail life, but if explosive returns come back, it can significantly boost a net worth. An auto buy of $20 daily through an advanced exchange can add up. For instance, a teacher who started this drip in 2018 turned $48,000 into nearly $1 million during the last cycle. He cashed half out at the top, paid the tax man, and bought another rental property. It's a lottery mindset without the lottery-level stupidity. Private equity and startups, the insider lane. At around $200,000 liquid, they unlock the insider lane. Equity crowdfunding and syndicate deals. Platforms like AngelList or Our Crowd allow you to invest alongside seasoned VCs for minimums as low as $1,000. They don't just spray and pray. They pick sectors they understand, verify a Tier 1 fund is already committed, and demand pro rata rights to double down later. The hit ratio is brutal. 8 and 10 might go sideways, but the remaining 2 can return 10 to 50 times, wiping out every flop. Over the long term, a disciplined and diversified angel portfolio has historically returned a 22 to 27% IRR, nearly triple the public market in some periods. You don't need to be in Silicon Valley, you just need to read deal memos like your net worth depends on it, because it does. Commodities, the chaos hedge. They also keep about 5% in physical gold and gold ETFs. It's not because they love shiny rocks, but because when markets sell off, gold has historically acted as a safe haven asset, rebalancing yearly by selling some high-priced metal to buy beaten-down stocks and vice versa is a classic strategy. This simple dance can add to annual returns while cutting portfolio volatility. Sleep matters. Side hustles, the fuel line. All of the above needs capital, so they build fuel lines. Side hustles spitting out $1,000 to $3,000 profit monthly. Hot plays right now include niche Substack newsletters, ghostwriting LinkedIn posts for tech CEOs, and renting camera gear through ShareGrid. That cash isn't for lifestyle inflation, it's the seed round for every other bucket. For example, one developer codes landing pages at $150 an hour after work. Every Friday that invoice goes straight into the crypto wallet. No friction, no temptation, just faster compounding. Exact funding order. Here's the checklist they follow in order: $1,000 starter emergency fund. 2. Employer 401k match, a free 100% ROI. 3. Kill any debt above 7% interest. 4th Roth IRA maxed in January. 5. Rest of 401k maxed. 6. Crypto allocation capped at 5%. 7. Real estate down payment fund. 8. Angel or crowdfunding deals. 9. Taxable brokerage for an early fire bridge. 10. Increase emergency fund to 6 months. Follow the sequence and you're playing offense and defense while others are still arguing over latte prices. If this roadmap is making your head spin, good. That means you're paying attention. Smash the like button so the algorithm shows this to someone still keeping their life savings in a low-yield savings account. And let's keep going, because the biggest mistakes come next. 4 traps that bankrupt smart people. Trap 1, lifestyle creep. Income jumps, they lease the Tesla, and compounding stalls. Trap 2, leverage overdose. Real estate is powerful until you're over-leveraged when rates pop. They cap mortgages at fixed 30-year terms and keep debt service below 40% of free cash flow. Trap 3, private equity FOMO. For example, skipping due diligence on a shiny pitch deck erased $50,000 from one investor in a doomed food delivery startup. Trap 4, ignoring taxes. They plan exits around long-term capital gains rates, which are significantly lower than short-term rates. They also harvest losses every December to offset gains and set aside a portion of crypto profits, so April never brings a surprise. Dodge those landmines, and you're already ahead of half the millionaire list. Tools they swear by: Index Core, Vanguard VTI or FZROX, Small Cap Value, AVUV, Crypto Storage, Ledger Nano plus a metal seed plate, Rental Analysis, the Deal Check app, Angel Deals, Assure Analytics to verify cap table hygiene. Automation, Zapier flows that sweep checking account surpluses into a brokerage on payday. Knowledge, the free secinvestor.gov database, not Reddit echo chambers. Bookmark them. Mindset, switch, earn, then own. Most people think in a linear fashion. Earn $80,000, spend $60,000, save $20,000. Young millionaires think in ownership percentages. Every deal they chase either gives them equity or they walk. A salary is a ceiling. Ownership is floorless. That mental shift turns a W-2 employee into someone collecting 3% of a $30 million startup. When the exit hits, the leap is exponential. Start asking, what piece of this can I own, at every opportunity? Sample portfolio at $100,000 net worth. Here's what it can look like at six figures: $45,000 in total market ETFs, $15,000 in small cap value, $10,000 in duplex equity, $10,000 in cash reserves, $5,000 in BTC, $5,000 in ETH, $5,000 in a gold ETF, $5,000 in an angel list syndicate, and $5,000 in speculative growth. The net result: 65% growth engines, 20% real assets, 10% chaos hedges, and 5% moonshots. The expected blended 10-year return could be around 12.4%, with a max drawdown of around 28%, half that of crypto-only investors. Scaling to seven figures. To cross the $1 million line, they automate contribution raises every time income jumps. Get a promo at work? Half the raise flows into investments before payday. Is the rental cash flow positive? Deposits sweep into the next down payment fund. Does crypto double? They harvest gains back to the target 5%, not for Lambos. That self-correcting loop can turn $250 monthly contributions into $1 million in 14 years at a 12% return. No lottery ticket required. If you got this far, you're officially out of excuses. Drop a comment with the bucket you're starting this month: crypto, duplex, index fund, whatever, and hit subscribe so you don't miss the next breakdown on how to analyze a rental in under 5 minutes using nothing but free data. Becoming a millionaire before 40 isn't about catching the next Dogecoin moonshot. It's about stacking small, repeatable edges most people ignore. Start the index engine, add a cash flow property, cap the crazy bets at 5%, and automate everything you can't emotionally trust yourself to do manually. Do that for a decade, and you might wake up one morning with a net worth that starts with a 2 comma surprise. The express line is waiting.